Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. We're going to look at Splunk stock, or Splunk, or however you say it, because it's taken a recent dip. And this is a stock that's been relatively popular over the past year or two because they provide data monitoring services, formerly as a legacy software, but they're transitioning into the cloud. So the question becomes, is Splunk a future growth prospect that you can get in on a stock that has recently dipped? Or should you be looking for other opportunities in this niche from some of their competitors? So we'll kind of go through what we know as of today and try to make a projection for the future. Reminder, as always, that my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your own research before purchasing any stock. And of course, if you like stock market analysis like this and other personal finance videos, then please subscribe to the 40 Finance channel. Thank you to everyone who has supported the channel so far. All right, I'm going to kick things off with a recent mention of Splunk in Motley Fool. This article was something about 3 great stocks for the long term, or some catchy headline like that. The article does a good job of outlining, what's going on with Splunk as of today. So you see that, the author says here that Splunk has been on a roller coaster ride for the last year. Following its third quarter update, shares were down double digits, leaving the stock up only 20% with a month left to go in 2020. In a normal year, that would be pretty good, but in a year which digital tools have turned absolutely crucial, Splunk is lagging behind. Goes on to say some of the volatility as of late is attributable to Splunk's migration from legacy software outfit to cloud-based provider. And where it gets interesting and where the opportunity is, if you believe in it, going from the old ways of billing customers to one based on cloud subscriptions causes some accounting headaches. As a result, total revenue was down 5% through the first 9 months of 2020. However, as the company continues its cloud makeover, annual recurring revenue, which combines old and new lines of revenue on an annualized basis, was actually up 44%. And 7% quarter over quarter through the end of October. Splunk also recently announced its new observability suite to help customers get a unified view, basically, new software. And then down at the bottom here, but there is lots of potential remaining as organizations will be migrating to the cloud and replacing their legacy IT infrastructure for many more years. Okay, so just to touch on the key points there, Splunk is changing how they bill customers. So during this transition time, you have the old world of, pay forward contracts where you pay for the service a year in advance for one lump sum. Now they're changing to a cloud-based model. That lowers the entry price for many companies, but it does require that you pay on a monthly usage basis. So some of what we're seeing right now with Splunk's third quarter issues is a transition in the way they bill customers. So if you're bullish and you think that the company will continue to retain and grow its customer base, then this is just an oddball year or so where the year-over-year comps are going to look funny because it's just different in the way that they're billing. On the bear side of that argument, when these contracts go through, are the ones that were projected ahead at 1-year terms start to fall off. Do those customers take the opportunity to look at what is turning into a pretty crowded field of data monitoring services? All right, taking a look at the stock today. This was before the market opened on December 8th. Looks like it's going to land around 155, not much change. It's important to note that Splunk does not have a P ratio, and the negative EPS there is, more or less a sign of what's happening here in 2020. And we'll take a look at EPS projections here in a minute. And you see the roller coaster ride that was described in the article earlier. Somewhere in the neighborhood of 175, I'll guess, is where we started prior to the pandemic. You've had a lot of ups and downs, but this recent third quarter report where you were down on the year-over-year comps, that's brought this stock, down to 155. The 52-week range, you can see that the high was 225. So if you look for value in the market based on earnings, like I mostly do, you could make the argument here like, hey, I could pick up Splunk, and even if it doesn't hit 225 again for a while during this transition period, it could certainly, get back to 193 or something like that. And that's, plus $40 per share. All right, so let's see what's projected from an EPS perspective. Last year, we had $1.88 on the EPS. I'm assuming that's non-GAAP. And then you see what's projected for this year is you are going to land in negative territory at minus 72 cents. And then next year, the average comes in at minus 3 cents. So it's better than this. It's still not back to par, if you will, from a year ago, but there is a lot of discrepancy on the analysts. This is the high, this is the low, and this is the average. So there's at least one person in the room who does expect to get back to last year's $1.88 or thereabouts. And this is where you would really want to dig into the company's annual reports and just make sure that a lot of their big contracts, that those relationships are going well. Splunk does have a lot of major S&P 500 company clients. So if, those guys stick around and sign up in the new billing terms, then you could definitely make the argument that we'll be back close to par, which is obviously a bull case for buying the stock at this low. All right, on the TipRanks side of the coin, we have pretty fresh updates here through up to 4 days ago, and pretty much across the board, you're over the $200 mark, right? You've got a 200, a 200, and then on the high side, you got a 260 and a 235. So analysts, anyway, are suggesting that the recovery play might be a sound one here because these projections are supposed to be looking out 12 months. All right, so the bottom line for me, and this is one, just to be fair, I do not own it. This is the first exposure I've had to Splunk. There's more reading that needs to be done. But the quick bottom line from the data that I studied is this does look like a potential easy 1-year swing trade at the current levels. So don't forget, 1 year from today puts you in, give or take December of next year. That's always a point that I'm looking at because I do not want to pay short-term capital gains. And Splunk does appear to offer upside over that term, just getting back to normal business operations. I found it interesting that ARK Invest recently added more of Splunk on the dip, so I think that that's a positive signal because they are not going to be the type of firm that invests in a company that doesn't have growth prospects. On the flip side, the projected growth rate over the long term is kind of concerning. I didn't post it on this particular video, but it was less than 10% growth rate projected over the next 5 years. And that data was from an Argus report that I was reading. So keep that in mind. This isn't necessarily another data dog or new company that comes in and just starts from zero and goes to 1 million. Splunk's been in the game for a while. So for them to grow, they need to bring on new clients. And it looks like there's some concern in that area. On the bright side, in the short term, you're starting at a discount level and you only need to get back to par if you're just going to do a swing trade, and you could make some good money. All right, the next thing I have here, cloud transformation might be too late. My only point here is that while Splunk's been in the game and they're a sort of trusted name, if you will, it is a wonky time to be transitioning to the cloud because so many of the competition is already there and likely securing clients. On the bright side of this, though, we go back to that article that I kicked off with. The cloud transformation for, legacy brands is far from over. So it's good to see that Splunk is growing and making adjustments to their business model. Just be aware, though, that there is competition out there. And, you could argue that it's more of the sexy names like Datadog. However, Splunk has the relationships and the existing contracts in hand, and hopefully that gives them an advantage. All right, and the last point, watch out for the next leg down if any more bad contract news comes in. And the point here on the contract news is, Splunk's kind of come in and said it's going to take a while to transition our contracts and for that to really show up in our comps. And I guess I just worry that if you had a Coca-Cola or Walmart or, whatever, some big company like that, your 1-year contract ends, you go on month to month, and things don't work out, you could be looking at a negative comp, depending on how big of the contract it was. I think Splunk's been around long enough that they're probably not too heavily invested in 1 or 2 clients. However, each one that drops off is an impact, and then you have to replace that money in order to grow for the long term. All right, so that's my take on Splunk. I would say that, make sure you're digging in, make sure whatever they're building in this cloud space seems like it will resonate with their existing clients and potentially open a new market for them. If you don't feel great about the contract status or you're unsure, there's still an opportunity in here for a 1-year play just to get back to par, sort of a safe bet, if you will. Instead of investing in a small cap stock that may or may not hit their contract numbers, Splunk probably has the better Rolodex of business, so to speak, and you can just bank on them getting back to where they used to be in a year or so and then jump out with your profit. All right, guys, hope this video helps if you're investigating Splunk. Please give me a like and subscribe if you enjoyed it. We'll see you on the next video.